Hello and welcome to Money Mine. I'm Joanne Lee. This week we look at the business of hedging. Remember, not so long ago, hedge funds were bitterly blamed for destabilizing the region's economies. Well, it seems they are back and once again flirting with Asian investors. Should you be wary of them, or can they be your alternative money-making option? Money Mine Tan Ping Ping checks them out.
32-year-old Kishor M isn't anything like a conventional hedge fund manager. While most in his trade would shun public scrutiny, this confident, eloquent man talks openly about a new hedge fund he'll be launching in Singapore in 2 months.
Our fund will basically be investing in global markets. We'll be trading currencies, commodities, gold, stocks as well. But the strategy will be more derivative. We are very confident that the hedge fund that we are launching will be a new asset class for investors who are looking for high returns, low risk, and we're looking at about a return of about 24 to 36%.
But that may be a tall order. Hedge funds globally have managed only paltry returns last year in the region of 7%, as shown by major indices. Still, Kishor is confident his hedge fund will take off with Asian investors.
If you look at the market performance of the traditional portfolio over the last 4 years has been very dismal. So people are looking for alternative investments, alternative sources of investing their money.
Kishor is not the only one who has spotted an opportunity in the business of hedging. The hedge fund industry has been enjoying a boom of sorts in the past 3 years. Assets under management globally passed the $1 trillion mark last year. The growth is especially remarkable in Asia. From Tokyo to Singapore, there was one new hedge fund launched almost every other working day in 2004. Currently, there are more than 500 hedge funds based in the region, managing assets of over $60 billion. A vast difference from 6 years ago, when there were merely 20 hedge funds in the market. So what's driving the growth?
Perhaps Asia's been off the radar for a few years since the sort of monetary issues in the late 90s, and people are now starting to look at Asia again. Particularly experienced hedge fund investors such as US endowments, Swiss fund of funds, and private banks. In terms of money flows into the industry, I expect the industry to grow from $60 billion at the beginning of the year to $85 billion at the end of the year.
There's a lot of appetite at the moment for emerging market risk, and in particular Asian risk. Asia is seen to be producer of capital, engine of world growth. And finally, from a hedge fund point of view, not only do you have still relatively inefficient markets, which means there's opportunities for clever investment managers, but structure of these markets are becoming much easier for hedge funds to deal with.
But where there are opportunities, there are also risks. Already, some are sounding the warning bells on the massive amount of capital flowing into hedge funds. Jim Rogers, the high-profile partner of George Soros for one, is convinced that the current hedge fund boom in Asia will soon come to a brutal end. His rationale: too many fund managers and not enough assets to go around. And this means many hedge funds may eventually end up delivering less than desired returns, or worse, go under. Fortunately, not all agree with this gloomy prognosis. This industry veteran believes that the problem is not in the lack of assets or skilled managers. Rather, it's the lack of information that will pose the biggest peril to hedge fund investors.
I don't think there's going to be a huge explosion. I don't think the bubble is going to go bang. But I do think that what will happen is that some of the less clever or less experienced investors won't find that they're getting the returns they thought, and will go home, and that excess of demand will fade away. So it's more like the foam on the top, I think, will blow off rather than the bubble popping. The main risk at the moment is that rapid growth is attracting in probably too many investors, not all of whom are going to be completely familiar with the investment landscape. And that's always a risk in any investment environment. When you have undereducated investors, it'll end in tears.
The high-profile collapse of long-term capital management is a classic example of how investors can get badly burned by the hedge fund game. The LTCM managers made headlines in 1998 for wiping out almost $4 billion of investors' money when their bets went terribly wrong. What's worse, nobody was in the know until it was too late for any reprieve.
Will there be another LTCM? It's always possible, but by definition it's not going to look like LTCM. And once something badly goes wrong, then human nature is you fix what made that go wrong, so what goes wrong next is going to be something completely different.
The LTCM incident actually highlighted that transparency is actually very important, because when the case was actually uncovered, it seemed that the managers took a high degree of leverage. And in that sense, due diligence on hedge funds becomes very vital.
Indeed, the painful lesson learned from the LTCM fallout has been firmly etched on the minds of industry players. This hedge fund manager, for one, is going to great lengths in making sure his investors are kept informed with daily updates of the fund's activities.
It's the moral responsibility of all the hedge fund managers. I totally agree that we need more transparency. This industry has certainly been performing pretty well. It's just that it's a little bit too discreet about what we do. So I think once hedge fund managers are more transparent and investors know exactly where the hedge fund managers are putting the money, why they're putting the money, and they are able to see exactly where their funds are being deployed, I think more and more people will be willing to come and invest in this kind of new asset class.
But the tough part is in finding a winning hedge fund team. The market may be flooded with a deluge of new managers. Trouble is, half of the hedge fund startups we see today are probably not going to make it past the 5th year. History has proven that.
For every, let's say, 10 new managers, I would say 3 or 4 are generally good quality that we would want to carry on researching. And one of the main differences between a hedge fund and a mutual fund is that in a mutual fund, a great deal of your return comes from the asset, comes from the market that the mutual fund is investing in, and a little bit from the manager, whether the manager gets it right or wrong, whether you pick the right manager or not. Hedge funds, it's the other way around. The return comes from the manager.
And that is why Jacqueline Liv of DBS Asset Management advocates investors go for structured products. She believes a fund of hedge funds which pulls together a group of managers can eliminate risks of a narrowly focused strategy.
But these are actually, if a fund of hedge fund were to be constructed, as what I was saying, more conservatively, I would only put it in between a bond and an equity. Having said that, to be mindful for the investors would be that there are some unique risks about the hedge funds, like liquidity risk and risk of blow-ups, etc., that they have to be mindful of when they are actually investing into hedge funds.
That said, the game of hedge fund is certainly no child's play and has just gotten tougher with the surge of new managers and hedge funds in the market. Knowing how to separate the wheat from the chaff is key in winning the game.
And that wraps up this episode of the show. Next week, MoneyMind looks at the biotech sector. Is there an appetite for biotech plays among Asian investors, or is the risk too much for the region's stock buyers to stomach? Join me next week to find out. I'm Joanne Lee. Thanks for watching. I'll see you real soon.